Ever wondered how the ancient wisdom of the Yi Jing can be used to predict market movements? Or how artificial intelligence algorithms can help us understand these movements better? Well, you're in for a treat. The Yi Jing, also known as the Book of Changes, is an ancient Chinese divination text. It's one of the oldest of the Chinese classics and has been an influential force in Chinese thought for centuries. Now, imagine combining this ancient wisdom with the cutting-edge technology of artificial intelligence. That's exactly what we're doing here. You see, the Yi Jing uses a system of symbols known as hexagrams to provide guidance on how to navigate life's uncertainties. These hexagrams are made up of 2 trigrams, each representing different elements such as heaven, earth, fire, and water. By interpreting these hexagrams, one can gain insight into the ebbs and flows of the universe, and by extension, the financial markets. But how does one interpret these hexagrams? That's where artificial intelligence comes in. Using neural networks and other AI tools, we can analyze the symbols of the Yi Jing, extract their inherent wisdom, and apply it to our investment strategies. This unique blend of ancient wisdom and modern technology allows us to predict market movements with uncanny accuracy. But it's not just about prediction, it's also about understanding. The Yi Jing teaches us that all things in the universe are interconnected. By understanding these connections, we can better navigate the complexities of the financial markets. And with the help of AI, we can do this more efficiently and effectively than ever before. To recap, the Yi Jing and AI are powerful tools for understanding and predicting market movements. The Yi Jing provides us with a framework for understanding the universe, while AI allows us to analyze this framework and apply it to our investment strategies. Together, they provide a unique and powerful approach to market analysis. Remember, the future is not set in stone. It's a fluid, ever-changing landscape that's influenced by our actions. By using the wisdom of the Yi Jing and the power of AI, we can make more informed decisions and shape our financial futures for the better. So keep an open mind, stay humble, and continue to learn and grow. After all, knowledge isn't just power, it's a tool to enhance your value. Thank you for joining us on this journey of exploration and discovery. Remember, the path to financial wisdom is strewn with both victories and cautionary tales. But by combining ancient wisdom with modern technology, we can navigate this path with greater confidence and success. Stay tuned for more insights and wisdom in our future videos.
In the recent past, traders were taken aback by the Federal Reserve's dovish stance, which led to the anticipation of 3 rate cuts this year. This unexpected move caused the US dollar index to tumble to the lower edge of 103 odd before making a rebound. The US dollar found itself in a whirlwind of volatility when markets were caught off guard by the release of the Fed monetary policy decision. The Federal Open Market Committee, FOMC, remained committed to cutting interest rates 3 times this year. This came as a surprise, as markets had already adjusted their stance to a mere 2 cuts prior to the Fed event. The repricing of the Fed statement resulted in a significant weakness in the US dollar, with equities rallying substantially higher. Thursday's economic data points couldn't have arrived at a more opportune moment. With the preliminary Purchasing Manager Index (PMI) numbers released, markets were able to confirm whether the Fed was correct in sticking to 3 cuts. A consistently strong economy could lead the Fed to tone down its rate cut expectations to just 1 or 2 cuts to maintain control over inflation, as robust demand tends to fuel inflation. On the international front, the Swiss National Bank, SNB, cut its interest rate by 25 basis points from 1.75% to 1.50%. Meanwhile, the Norwegian Norges Bank kept rates unchanged at 4.50%, and the Bank of England also maintained its policy rate, deeming it too early for a cut. Thursday's US economic data releases start with a mixture of data. Current account data for Q4 is seen heading from a 200.3 billion deficit to 295 billion. The Philadelphia Fed manufacturing survey for March is expected to head from 5.3 to a contraction at 2.3. Initial jobless claims for this week are expected to climb from 2.9 to 2.5%. Continuing jobless claims were last week at 181 million. S&P Global will release its preliminary purchasing manager survey for March. The services PMI is expected to head from 50.3 to 50. The manufacturing PMI should be heading from 52.2 to 51.7. The composite PMI was at 50.5 in February, with no forecast penciled in. At 14 GMT, existing home sales data will come in with a small retreat from 4 million to 3.94 million expected. Federal Reserve's Vice Chair for Supervision Michael Barr will speak around 16 in SAC GMT. Equities are holding on to overnight gains and are advancing further. Japan and China saw all their major indices close off with more than 1.5% gains. European equities are steady, just below 1%. And US equity futures are seeing the Nasdaq leading the charge by soaring near 1% ahead of the US opening bell. According to the CME Group's FedWatch tool, expectations for the Fed's May 1 meeting are 91.5%, keeping the rate unchanged, while chances of a rate cut are at 7.5%. The benchmark 10-year US Treasury note trades around 4.23%, the lower end of this week. Following the Fed meeting on Wednesday, the US dollar index DXY is experiencing a mild period, with the DXY bouncing back on Thursday, partially offsetting the losses from Wednesday as markets readjusted to 3 cuts. Traders should be very well aware that entering a trade in US dollar means tighter entries and stop losses, as volatility in the past 3 months, from January to March 2024, was only around 6.5%, far less than the 14% seen in the 3 months prior, from September to December 2023. In summary, the Federal Reserve's unexpected decision to anticipate 3 rate cuts this year led to a brief moment of weakness for the US dollar. However, the currency has since recovered, although it has entered a phase of volatility. The ongoing economic data releases will further clarify the situation and potentially influence the Fed's future decisions on rate cuts. As we move forward, traders and investors alike will need to closely monitor these developments and adjust their strategies accordingly. Ever wondered what the Bank of England's policy rate is all about and why it matters to you? Well, it's time to dive into that today. The Bank of England is expected to leave the benchmark interest rate unchanged at 5.25% following its policy meeting on Thursday. The policy rate, or the bank rate as it's also known, is essentially the interest rate that the Bank of England charges banks to borrow money. This rate can fluctuate, influencing everything from the interest rates on your savings and loans to the strength of the pound and the health of the nation's economy. Speaking about inflation, the headline Consumer Price Index (CPI) in the UK rose by 3.4% in the year to February and 4.5% when it came to the core CPI, that is, excluding food and energy costs. So, what's happening with the Bank of England's policy rate right now? As of the last meeting, the Monetary Policy Committee voted 8-1 to keep the policy rate unchanged at 5.25%. 5%. What does this mean? It means the cost of borrowing for banks remains the same, which in turn influences the rates they offer to customers like you and me. But the policy rate isn't just about borrowing, it's also an essential tool for controlling inflation. If inflation, the rate at which prices are increasing, becomes too high, the Bank of England can raise the policy rate to cool things down. On the flip side, if inflation is too low, the bank can lower the rate to stimulate spending and economic activity. This time around, despite a reduction in the bank rate, the Bank of England's monetary policy might retain its restrictive nature. Significant indicators of inflation persistence remain high, which is why the current restrictive policy stance is exerting pressure on the economy, easing the labor market, and suppressing inflationary pressures. In fact, the Bank of England is seen potentially reducing its rates earlier than estimated following softer than expected inflation data. This could have a significant impact on the pound, which is why investors around the globe will be closely watching the bank's decision. Furthermore, 1 year ahead, CPI inflation expectations declined to 3.3% in February, down from 3.4% in January, while the expected year-ahead wage growth remained steady at 5.2%. In addition, 3-year ahead CPI inflation expectations dropped to 2.8% from 2.9%. So, what's the takeaway from all of this? The Bank of England's policy rate is a critical tool for managing the UK's economy, affecting everything from the cost of your mortgage to the price of your weekly grocery shop. By understanding how it works, you can make more informed decisions about your own finances and investments. To sum up, the Bank of England's policy rate is currently set at 5.25%, with a restrictive stance on monetary policy continuing despite a reduction in the bank rate. Inflation indicators remain high, putting pressure on the economy and labor market. However, softer than expected inflation data could lead to an earlier than expected rate reduction. So, keep an eye on the bank's decisions. They matter more than you might think. Have you ever wondered how ancient wisdom can guide modern financial decisions? This video will explore how the wisdom encapsulated in Tiāndì P can guide investors through such times, offering strategies that embrace balance, adaptability, and the interplay of opposing forces to find a path to success. We'll explore tales of financial captains who successfully navigated through treacherous markets and those who hit the rocks. Spoiler alert, those who listened to the ancient winds fared better. Today, from a professional standpoint, linking the dynamics of the US dollar and Federal Reserve's monetary policy decisions to the management implications derived from the philosophical concepts of the Tiāndì P hexagram in the Yi Jing offers a unique perspective on strategic planning and decision-making in business environments. The ancient Chinese text, the Yi Jing, or Book of Changes, provides an intriguing framework for understanding the dynamics of the current financial market. In the context of financial markets, this can be likened to periods of volatility or uncertainty when traditional indicators and strategies seem at odds with market movements. The Yi Jing is a treasure trove of philosophy and wisdom, with 64 hexagrams, each symbolizing different states of being. Among these, the dovish stance of the Federal Reserve, despite expectations, of rate cuts serves as a contemporary example of Tiāndì P in financial markets. Investors expecting alignment and clear signals find themselves navigating a landscape where the usual markers of decision-making appear in discord. It represents a moment of disharmony or stagnation when heaven and earth do not align. This concept parallels the state of our current financial markets, characterized by volatility and uncertainty, where traditional strategies seem to contradict market movements. Take, for example, the recent dovish stance of the Federal Reserve. Despite expectations of rate cuts, investors find themselves navigating a disoriented landscape where the usual markers of decision-making appear in discord. This is a modern rendition of Tiāndì P, a time when clarity is clouded and strategies need to be rethought. Drawing from the ancient wisdom of the Tiāndì P hexagram, we can identify several strategies to navigate this challenging terrain. Firstly, we must adapt to change and uncertainty. The recent volatility in the US dollar and the Federal Reserve's dovish stance, suggesting potential rate cuts, highlight the importance of agility and readiness for change in management. Similarly, the Tiāndì P hexagram reflects periods of standstill or decline, advising patience and caution. Management should therefore be prepared for sudden shifts in the economic landscape, mirroring the Fed's readiness to adjust its policy based on economic indicators and market reactions. Secondly, consider the power of strategic patience and timing. The surprise caused by the Fed's dovish remarks led to a temporary weakening of the US dollar, reminding us of the importance of timing in decision-making. In uncertain economic times, waiting for the opportune moment to act can prove beneficial. Thirdly, embrace restriction as a strategy. The Fed's indication of future rate cuts in response to strong economic data mirrors the concept of restriction for the greater good, as seen in the Tiāndì P hexagram. This perspective encourages accepting limitations or conservative strategies to prepare for future growth opportunities. Fourthly, prioritize communication and transparency. The Federal Reserve's communication significantly impacts market expectations and reactions. Similarly, the Tiāndì P hexagram underscores the problems arising from miscommunication. Fostering open channels of communication is essential for navigating through periods of uncertainty. Lastly, PG Tai Lai. From the worst conditions, things will improve. Always be prepared for a reversal. Just as the Tiāndì P hexagram signifies a period of stagnation or decline, it also suggests a subsequent period of renewal and growth. This resonates with the financial market's cyclical nature, reminding investors and businesses to anticipate and prepare for change. Management should, therefore, not only brace for potential downturns, but also prepare to capitalize on the opportunities that arise when the situation starts to improve. By embracing change, exercising patience, accepting restrictions, prioritizing communication, and preparing for reversal, we can chart a successful course through the choppy seas of financial uncertainty. In conclusion, the ancient wisdom of the Tiāndì P hexagram can provide valuable guidance in navigating the current financial market scenario. I would like to express my gratitude to all the viewers for their support at the end of this episode. Do you know, each region on Earth has its own specific longitude and latitude, as well as its own unique environmental resources. If there are any topics that pique your interest, please leave a message. This channel is based on a humble heart. It's important to always be open to new ideas by using neural AI calculations to scrutinize the distinction between the appearance and reality of facts and emphasize the connection between knowledge and action. Continually learning and improving in practice is key. Combine the ideas learned during previous doctoral studies with the current situation. If you think that today's video has gained some momentum, don't forget to like it so you can find it later when you want to watch it. I want to express my gratitude for your attention. Thank you.